All right, hi everyone. I'm Vinny Celeste with DeRosa Group, and I'm sitting here today with the expert asset manager Justin Fraser. I actually had some questions for him in one of our monthly meetings, and hey, why not record it and send it out to everybody? Justin, hoping to pick your brain a little bit about one of my favorite meetings that we do, going through the dashboard here and really connecting the physical world to kind of data that we track.
Vinny, thanks for having me. And this is a topic that we don't really share enough with our audience. I'm really excited to dig in on some asset management, what we look at on our side, and how I'm measuring the health of our properties. And so, as you said, we meet once a month where me and my team share this dashboard with everybody, and we share with you guys the results of a few key KPIs on how each property is doing, so the team knows the health of our properties. So this is data that's taken from a recent update that we did. We did scrub property name, we scrubbed actual financials here, but this is a real life dashboard. We can talk through some very real world numbers here. So Vinny, you want me to just take us through section by section here?
Yeah, why don't we do it that way?
So up in the top left, we have our financial snapshot. Obviously, we've pulled out our bank balances here, but this shows at a high level, where are we with a few of our key bank balances. And you may not realize this, but every property that we own has 5, 6, 7, 8 bank accounts. There's each property, and they're all for different things. First one here, operations bank balance. Operations is what does the property have in operations? That's the money that the property's collecting in. When they deposit their rent, it goes into the operations account. When they pay the bills, like the landscaping bill, like any expense that comes from the property, it comes out of that operations account. So we want a snapshot. We want to see how much money is in that operations bank account. Number 2, operations payable. So sometimes if a property is not performing super well, we may start to accrue some payables. That's never a good thing. So we all have an idea on how much money do we have in payables. Now, hopefully the operations account is very big, the payable account is very low. This is data that we want to look at to make sure that the property is performing in a healthy way. Then we have the site CapEx balance. So we have an account that the property has that we designate just for construction. Let's say I approve a project for $100,000 to repair some roofs. I'm going to send that money from the next account there, the construction bank balance. That's money that I have on my side that the manager doesn't have access to. I'm going to send that $100,000 from my construction account to the site CapEx. So that's the difference there, is that the site CapEx is for approved projects. That's money I'm putting in, and the construction bank balance is my reserves for our construction account. And usually that's built based on our CapEx budget. Our capital account balance, that's our reserve account that we keep on our side. In addition to the construction bank balance, just in case, rainy day, we try to keep a few months of operations reserves tucked away on our side in case we get into any trouble. And finally, CapEx committed costs. That's just looking at how many dollars have we committed out there. And that's helpful if I see that we've approved $1 million in projects, but I've only got $500,000 in the construction balance. I've overextended myself. It's a good way to understand how much of our money have we put out there and committed in projects to do. Those are the main accounts that we want to look at.
Great.
Yep.
Yeah, take me on to occupancy.
Okay, so occupancy, everyone understands occupancy, I hope. We've got 2 lines though, economic occupancy and physical occupancy. And so this is a property that used to be about 12 months ago in the mid 80s. We then dropped down by April to about 79. We kind of hung out April, May, June, July, and that 79 to 80% occupancy. And then since there into the fall here, we've climbed back up and we're just about 90% here. And so this is great because it tells us the story, the last 12 months of what's been happening physically at the property. The economic occupancy is how much money we've collected based on how many people are living in the property. And so something interesting here where, let's look at a month like December of last year, our economic occupancy was actually higher than our physical occupancy. And we're seeing a lot of this because the eviction moratorium that was happening last year, the rental assistance that came in, we went months and months and months without collecting a penny from some of these residents, and then the rental assistance finally hit and they were paying 4, 5, 6 months at a time. So some of our months, our cash collections went through the roof, the occupancy went through the roof, the economic occupancy went through the roof because we were collecting all this money backwards and sometimes even paying forward. So that's a little out of sync. Ideally, economic and physical occupancy would be in lockstep every step of the way, but you do see some variations there.
And you touched on this. This is probably clearest linked to the physical world. Can you tell us a little bit about what was happening, why we might see this type of curve at least in this specific example?
Yeah, so for this property, we had to come in and do some heavy renovations. We had a lot of folks going through the early part of this year that were being evicted out of the property. They were not paying their rent. We had a lot of churn where folks were leaving. But that also gives us the opportunity to renovate those units. And around March, we really kicked up the number of units that our team was renovating each month. And it takes a little while for that to kind of work through the system and get the leases. But then you see by the summer, it really started paying off. And now we're in a point where we climb back out and we're heading towards stabilization.
So collections.
Again, we're looking at 12 months here of collections. We've got our blue. This is cash. This is how much cash came in the door at the time of the end of the month. If I looked at these numbers now, they would be very different because we tend to collect for the previous month after that month ends. It's just a one snapshot for each month at the end of the month. It's kind of all over the place because a lot of times we'll get prepaid rents. Depends on the day of the month that the payday lands on. Depends on rental assistance from earlier this year. But as you can see here, the trend is that the blue line is getting larger and larger and larger as we go. And that means we're collecting more and more and more. So the other thing is how much delinquency, how much at the end of the month, how much money are we calling delinquent? You can see that red bar is getting smaller and smaller as we go, which means more and more people that are even in the property are paying their rent. Then of course you see October here. We are recording this here mid-October. We would love to, but we don't always collect every piece of our rent on the first of each month. It actually takes us a full 30 days, sometimes 45 days or more to collect most of the rent for that month. You know, that's why it extends into the next month. Sitting here mid-October, feeling pretty good about where the collections were. This actually was a snapshot from a few days ago, but feeling pretty good about where those collections were. Now, that's pretty much in line with where most of our properties end up around the third of the way through the month mark. So it's not that we've had a huge fall off here in the next 2 weeks as we continue collecting for October. It should be in line with the previous month. Yep.
All right, scrolling down.
Yeah, so here's where we get some juicy stuff going on, all right? On the left here, the unit renovated count. This is just literally counting how many units have we renovated. I love that line. It makes me so happy when I see that nice, fairly even trend line of just units after units, making progress every single month. And you can see there where we were in March and into May, there was a bit of a jump up and we just really started pushing here through the rest of the year. We also have, sometimes we have turn units, would be like a make ready, and then we have in progress. And then, so how many have we turned? How many turns are in progress? How many renovated are done? How many renovated in progress? Essentially here at the end, we're somewhere around 260 out of our 300 plus units have been renovated or touched in some way here.
I just find it so interesting too that the units turned, like that's pretty consistent. It seems to be pretty cyclical that people are moving out at that sort of rate.
Yeah.
And that.
So this is cumulative. And so actually what happened here was in our business plan in the very beginning, we said, let's renovate some and let's turn some units, which essentially is like a classic renovation here. We kind of changed our terminology a little bit. But it was about a year ago. So we said, let's not turn any more units. Let's just renovate everything. Let's do the full package. We're getting great rents. Yeah, that number is pretty consistent there. You can see how it's fairly consistent. We did start this year doing a few more turns towards the end of the year, those green bars there. But really, for the most part, that's staying consistent. We're just focusing on the renovations now moving forward because that's what makes sense for the market, for the business plan that we're in.
Did you talk a little bit about how that's affected the value of this property in particular?
It's through the roof, right? And actually that ties up to our next section. The more we renovate, the more higher rents we get. We're exceeding our business plan goals. And so every time I renovate a unit, I'm taking a unit that maybe had been rented in the 600s and market rent on these is the high 800s, even pushing into the 900s, depending on the unit type. So we're making a huge swing there as we're renovating those units. So this is a great chart. I love this chart because it shows us a few key pieces of information. Our underwriting NOI. When we put this deal together, what were we expecting this property to make? NOI is income minus expenses. We want this property to make $105,000. We project it'll make call it $106,000 a month in NOI. And so what we're now doing, and we're in year 2. So we have that red line that shows our underwriting NOI, and then the blue line is how we're actually performing and tracking against that. So you can see a few key things in this chart. The red line from September to October, we bought this property in October 2020. And in September, we had a bump up from year 1 to year 2 for what our underwriting NOI would be. And when we have this chart extends out to October of this year, that chart's going to tick up again because we were projecting our third year underwriting NOI to be higher than year 2. So you're going to see another bump there. The great news is, more than made up for it. And that kind of tracks to the chart below it, cumulative NOI. This is something that cumulatively, we should have had an NOI that's during the last 12 months of $2.313 million. So we should have had an NOI of 2.313. The red line is what we budgeted to have. So we budgeted 2.061. We are in the green. We've made $252,000 more in NOI than we thought. Obviously, we want to be ahead. We want to be making more than our budget was. But that's the sum of all of these numbers and all the 12 months before. We're exceeding our target budget.
So then we know we're still on track here.
Exactly. That's like how much wiggle room. We could go and lose $250,000 and still be on track. And then finally, the bottom left here is our OPEX percent ratio. You know, we hear a lot of sort of rule of thumb is a 50% expense ratio is good expense ratio for a property. It varies wildly every month, as you can see. For the most case, the last 12 months or this calendar year, we've been between 41 and 45%. This is a good, healthy expense ratio. Anywhere we're hovering around that 45% mark, we're pretty happy. That just helps us keep in line. You know, if this suddenly spiked to 60 or 70%, that'd be a huge indicator for us that maybe something is going on at this property that we need to look at a bit closer. But all these things collectively, no one piece of data tells us, is this property doing good or bad, or is it making money or not making money? But collectively, these sort of 5-6 charts give us a pretty good indication on how healthy this property is.
And that really helps with kind of what I wanted to talk to you about at the end here. So you're living this every day. We've spoken about this a little bit, and it's never really truly a surprise to you when we're looking at this data because you're feeling it every day. What are some other things that we track and what being an asset manager is like from that regard?
Yeah, I mean, look, financially, we're looking at a deep dive on the financials every single month. And so I'm comparing not only against our budget, but against the previous months. You know, I'll do a deep dive review on our financials with our property managers every single month. So really getting an understanding of every line item. Now that is way too much detail for the team and for the scope of this dashboard, but we do provide those financials on a quarterly basis out to our investors, and they get to see all the details on what's going on. But we're looking at all the financials, reviewing that in depth with our managers. Okay, we have a whole property management tool system that gives us all kinds of KPIs, but this data here is our team the best information for them to be informed on what's happening on our properties.
Thank you so much for your time. Truly, this was a genuine meeting of the minds. I appreciate kind of the walkthrough here.
Absolutely. Listen, absolutely. And if you don't measure it, you can't manage it. We've gotten a lot more control over all of our assets once we started measuring these things and putting them up in a dashboard so it's easily to see and easy for everyone to talk about how we're doing. That's my tip for everyone. Measure, and understand how your property is performing relative to your plans. Thanks for having me, Vinny.
Thanks, Justin. Take care.